efficient market hypothesis is actually the hypothesis that we work with. This is very controversial. A lot of people on Wall Street will probably even laugh at us, but we actually believe that the efficient market hypothesis is the best theory as far as markets are concerned. Okay, let's be clear here. This is a market theory, which is not the fundamental theory that we base our investments on. Our investments are based on the principal stack. But as far as thinking about the market, so this is kind of like, think of us like if you're a sailor on the ocean, you have a certain way of navigating your ship, but then you also have to have a bit of a sense for the weather and the general oceanographic circumstances and all those things, which are external factors. So that's how we think about the markets. So we actually think that an efficient market hypothesis is the best hypothesis to work with. And I want to explain why it's controversial and why we believe it's the right hypothesis. This is Not in Wrong podcast. It's October 11th, 2021. This is Krimdelko. For the day, the fund is up 1.9%. The market's up 0.5%. For the year, we're up 9.8%. The market's up 16.8%. We are underperforming by 7%. So let's first talk about the efficient market hypothesis and then explain why this is the best hypothesis that we believe we have as a fund to navigate the markets. The efficient market hypothesis says that as far as fundamental information, the market is the best place to reflect information as instantiated in market prices. So what the efficient market hypothesis is saying is simply that given what's known fundamentally, this is the best possible guess we can have in terms of asset pricing. And we believe at Orange Capital Partners very much that this is the right way to think about this. Now, let's dissect this. First and foremost, what is fundamental information? Fundamental information is information that is knowable by aggregate people. So what let me try to explain what it's not. Maybe that becomes a bit more clearer. Fundamental information is not forensic information. If you're a cheat, if you're a fraud, if you're a criminal, it's not going to be reflected in the financial markets, at least not as they are functioning now. We could incorporate that too, and I'm going to talk about this in a second. But cheats, frauds, criminals, that's not part of the financial market hypothesis. That's not part of what the financial markets are not in the business. When people wake up in the morning, people who are operating in the financial markets, they're not the FBI. They don't go after criminals. So this is very important. A lot of short sellers say the efficient market hypothesis is it doesn't work because, look at this fraud, look at that fraud. Well, that's not the business of the financial market hypothesis. And by the way, this is not to say that you can't make money with forensic accounting and being a short seller by catching frauds. That's not what I'm saying. I'm just saying as a general hypothesis of how the markets work, we're not going to try to out-beta the market. This is what it means in jargon. The market's good enough for that. What we're going to go is after alpha, and alpha is you can get alpha by finding criminals. One. Number two, technology risk. Again, the market is not very good at pricing technology risk because it's idiosyncratic and bespoke. And that same applies to criminals. Idiosyncratic and bespoke. It's not something you can aggregate, you can extrapolate, you can ask 10 people and get 75 yes and 25 no, and then say, well, okay, that means it's rather yes than no. Technology risk doesn't work like that. Technology risk it's binary. It's either it works or it doesn't. If Tesla can do the 4680, there's nobody in the market that can actually assess if that's going to work. It just doesn't work. Even Drew Ballino, even Elon Musk, they don't know. They're going to try. They're going to, try and error and all that stuff, and they're going to figure it out. And they're very Popperian. Maybe they don't say it that way, but it's a very Popperian process. There's no authority. Nobody knows if it's going to work. We're going to try, and we're going to try to lower the cost of iteration. We're going to make sure we don't blow up if it doesn't work. All these things, this is what managers do. This is what Elon Musk and his people should be doing. They should be making sure that Tesla can survive even if they don't figure out how to make 4680 at scale. And so far they've been phenomenal at it, but when the Model 3 was launched, they had some issues and the company was on the line. So sometimes that happens. But again, bespoke, idiosyncratic processes, the markets are not terribly good at it. Again, I'm going to talk about the possibility to incorporate that into the marketplace also. But for that, we would need a certain type of security and a certain type of investor class. In other words, we need people to actually wake up in the morning and think about these things more in an aggregate way. Not the engineer who actually works on it, because that's not his job. It's not his job to price the probability of success of the 4680 cell. That's not what they do. You could make it his job. You could incorporate a future for the success of that kind of thing. You could have a future for fraud, things like that, and the market price and people actually trading and have liquidity, but we don't have that right now. There is no such thing as an internet bubble. There's no such thing as a housing bubble. All these things, there's never bubbles. What is the fundamental information which is priced today is perfectly fine. Now things can change. For example, take housing. Well, I could have a change in the NIMBY restrictions in the Bay Area and open up real estate for construction in a much broader scale than it is has been so far in the Bay Area, and I guarantee you for the next 10 years real estate prices in the Bay Area will not go up. But that's not something that the market's pricing right now, because the market is pricing relatively steady, predictable NIMBY areas, which are the main reason why we have high housing prices here. It's not because we have the tech industry and demand, it's because we just can't build new houses and have supply, and you have higher demand, prices go up. It's very simple. So again, we believe that as far as a fund is concerned, again, from our perspective, this is not academic, this is real. We just don't spend a whole lot of time thinking about mispricing of stock. This is what it really means. We don't think that Tesla is mispriced. We think that given the information available out there that is available to us from the market, so whatever Tesla is telling us at analyst days, at investor days, at AI days, and so on and so forth, all these things, they should be, they are reflected in the price. They are reflected in the price, and we shouldn't worry about that. What we should be worrying about is, again, the degree of freedom, which is, okay, which stock are we going to invest in based on based on what the principal stack is telling us we should be investing in. And then once we find that company, we're not going to worry about the valuation. This is what it means. We barely spend any time on valuation. Now, having said that, of course, we have to have a little bit of a sense for what kind of returns we're going to get. So what are we thinking about? Vinod Khosla once said, if I have to think about ROI, it's not interesting to me. And I find that to some extent true. I agree with that. We at Orange Capital Partners think the same way. But given that we invest in, to some extent, very high market cap type publicly listed companies, it is certainly not possible that we have 100 or 1,000x on Tesla in any time soon. This would just, it would just explode every kind of metric that humans can think of. So in other words, we are exposed to a more broader sense of how stocks are priced and things along those lines. So for example, with Tesla, what we think is that Tesla can be a 1 trillion sales company in 10 years and then trade at maybe $3 trillion market cap, 3 times sales. So these are the kinds of things that we do think about. But this is more to get a sense, okay, where do we stand? What kind of expectations can we actually have within the realm, again, of the efficient market hypothesis, of an hypothesis that is within the context of what's fundamentally available to us as information. We're not saying that this is going to happen, but within the context of, again, broader markets. So this doesn't apply to any bespoke or unique innovations that Tesla can do. Given where Tesla is today, we go from 60 billion to $1 trillion in sales, and we go from 800 billion to, let's say, 3.5 trillion in market cap. It has a high teens annualized return. This is efficient market hypothesis. Given the fundamentals, given the information that's out there right now, today, where we stand, this is what we expect. Now, we at Orange Capital Partners also have a bit of a unique way of looking at things, and some people in Silicon Valley, they would say, well, you have to know something that nobody else knows, and things like that. I don't think it's about knowing versus not knowing. It is definitely about having a view of the world that others don't have. And how do you get a view of the world? By educating yourself, by getting knowledge others don't have. Observations are theory, laden. I spoke about this in one of the previous episodes, and this is exactly what it means. That we build knowledge, theories, and then we have an observation like everybody else, but we interpret it differently, and this is the power of knowledge and theories. This episode is really to put out there a very controversial view of the world, and this is that we believe that the efficient market hypothesis is actually the right way to think about the market. The implications of that are we're not trying to out-beta the market. We are not going to be able to call over or undervaluation of stocks. We can't do that. We don't have the aspiration to invest in knowledge, technology, any kind of edge or stuff like that, that would give us the ability to make money by exploiting deviations from the efficient market hypothesis. This is what it really means. Maybe some people have it. It seems like within the algorithmic trading space that's possible because within the very short term, these people are able to exploit certain mean reversion strategies, which in our view is not really going against efficient market hypothesis or anything like that. All they do is they take things like liquidity risk and other types of risks. So let's put that aside. Again, for us, we are in the business of selecting the companies that best fit into our principal stack. And the principal stack is supposed to serve our mission. The purpose of Orange Capital Partners is to generate wealth by investing in fundamentally new concepts and engineering practice. We actually have a goal, which is a 15% unlevered return after commissions and fees. Now that goal is really more of a North Star than a hard number. Right now, we're way above that. We are more in the high teens, which is a lot given that we've been in business for more than a dozen years. So every percentage over 12 years compounds quite a bit. So to be almost 5% above that target is amazing. But that's not the point. The point is to give people a sense. And the purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. So I'm urging people to have a little bit of a sense. Okay, where do I stand? What is it I actually think I can do with my investment and with my work? And because it's interesting, like some people might say, I can give you 5%. And then I would say, well, why are you even in business? 5%? What is that? You're going to wake up in the morning every day and work for all your career to do 5%? Now, yes, I get it. The interest rate environment is almost zero and 5% is still good. But honestly, you can do much better doing something else. 15%, that's worth trying to achieve. That is worth waking up in the morning. That's a lot. A compound 15% over 40 years, that's quite a good return. So this is why this goal that we have is, I think it's important. I urge people, before they even start a hedge fund, before they even write the partnership or incorporate the company or whatever they do, think about what is your goal and state it clearly, put it in writing. And if you don't have the guts to put a high number as an achievable annual rate of return, well, then don't bother. And if you have the guts and put it in the paper, then lean back and think very, very hard how you're going to achieve that, because a 15% return or whatever your goal is, it's not going to be easy. I can guarantee you that. So we at Orange Capital Partners we have the ambition to generate wealth by investing in fundamental new concepts and engineering practices with large impact. We are not in the business of trying to prove the efficient market hypothesis wrong. In fact, we are even using it to our advantage. Now, what does that mean in practical terms? It means that when we're in 2000 and the internet bubble is bubbling and bubbling and bubbling, we're not concerned. When we're in 2008, we're not concerned. We're not concerned because we're not concerned right now. We're never concerned about the market mispricing the aggregate fundamental information about the stock market or assets in general. We spend a lot of time thinking about unique, bespoke, idiosyncratic, fundamental reasons that could either increase the valuation or lower the valuation of an asset. We spoke about technology risk, a very important part of our investment process. For example, CRISPR has a lot of technology risk. There is side effects. There is efficacy. There is, in the CAR T space, how long can these CAR T cells survive? We don't know. We know conceptually what we can do with CRISPR and base editing and prime editing. We have a concept of what allogeneic CAR T cell therapy is, what immunotherapy is. We have a concept of how we can solve at least monogenetic diseases and then also multigenetic diseases. But we don't know how it's going to work. This is idiosyncratic. This is something, that's why we spend a lot of time talking to academics, people in that field of operation. Not because we want to be fancy about jargon. It's because these people are the best source of knowledge when it comes to these types of questions. We don't talk to macro strategists on Wall Street who talk to us about the valuation of the general market because we don't care. Your daily agenda is who you're going to be in 5 years. What is it you're doing today? What's your agenda today? That's who you're going to be in 5 years. So if you spend your time trying to somehow play the efficient market hypothesis, if that's your game, then you're not gonna. That's who you're gonna be, and you're gonna play against the efficient market hypothesis. And let me tell you, we believe at Orange Capital Partners that you're not gonna be able to generate wealth. This is just a hypothesis. We could be wrong. Again, if you have an in onto that, if you have, for example, a short-term way to exploit over-under reactions in the market, because there are such things maybe in the short term, there's possibilities of that. If you ask me, again, it's more things like liquidity risk and those sort of things, and it's not actual emotional overreaction or things like that. And in practical terms, that means that there is a risk called, let's say, liquidity risk that you don't know how to price. And you can actually blow up. That's what happens. You blow up sometimes. And that's the problem with all these so-called non-efficient market trading strategies. Yeah, they work until they don't work. That's the problem we have with them. We at Orange Capital Partners have not found a way to explore emotional mispricings in the market to generate wealth, nor do we care, nor do we have technology or ambition to do that. That's not our business. Let's be clear about that. And it's not a religious conversation, should or should we not. It's just we chose not to be in that business the same way we chose not to be in the bakery business or any other type of business. We're in the business of generating wealth by finding idiosyncratic ways to generate knowledge. And again, knowledge is theory laden. So we're not under the illusion that we have observations that others don't have. It is the theory that we build around those observations which gives us an edge, and hopefully we can generate wealth. This is the business of Orange Capital Partners. Thank you.